PhD studies at the
Hey everyone, so we'll get started. Can you guys see my screen?
Yes.
Okay, brilliant. Good. So the usual, just a quick introduction about us. So, a nice quote from Warren Buffett about holding a stock for 10 years and not for 10 minutes, which is quite relevant for what's going on in the markets at this stage. And then a reminder that we are just a community. The idea here is that it's not me giving a speech. It's about us helping each other, just like Reddit did for a lot of investors. Some made money, some didn't, but still. And again, we are not asking you to buy or sell anything, because if I did, I might be on a hearing with the House, which is going on right now in the US. So we are, as most of you guys know, we are, 13 groups in several countries and growing. So it's great to be in such a state. Sorry, I'm just checking my phone because some people are struggling to get in. Just give me 1 second, guys. I need to check. Okay, so the other thing is, if you need access to our previous webinar recordings, you can go to cityfalcon.com meetup, and we will post this recording as well in a couple of days. So, I think a lot of you guys weren't present, but when we started this group back in 2015-16, Blue Mobile was one of the stocks that we discussed early on. And what is amazing is that the company got acquired by Electronic Arts at $12. So just a little bit of history. We looked at this company around 2015-16 over here, when it had already declined quite a bit. And what we found was that the company's revenue was more than its market capitalization. And this, as a value investor, was great for us. Also, we looked at the growth opportunity in the company with video games becoming more popular as smartphone access, internet access were improving. And so we bought this company. A lot of us did. I haven't held till now. I booked my profit at about $7 or $8, but I know some people who are still holding, so they made a 4x return, which is great. And great to see, value investing still working for a lot of people. So what was fun about this experiment, this investment, was when we did our research, one of the most popular games was Kim Kardashian. And I actually played this game to understand why people were interested. Obviously, I gave up after the first session in the game. I'm not the target audience, but I could see why it could appeal to a younger generation. And this made the investment case for us. So the thing we're going to talk about, one of the things is, and I don't know if you're hearing the House hearing right now in the US, where it's Robinhood, the Reddit guy who started, this kind of action in Gamestop, and then other market participants. They're discussing whether it was legal, what companies could have done better. So all of that discussion is going on, which is quite interesting. So if you have time, do spend, listening to the recording. So obviously, as everyone knows, what had happened was, what had happened was the stock was at, I don't know, whatever, $3, $7 last year. And then it went to, it says 350 here, but I think the high it reached was something like 475. And now it's, I think right now it's at about $44. And this is quite interesting. Like the markets have been, like there's been such a lot of learning in last year and this year. It's been crazy. Does anyone hold Gamestop or is tracking or is interested in buying?
No.
No.
Anyone looking to sell GameStop at this level? Okay. So yeah, so I mean, I think most people of any fundamental research that you look at would still say that the company is expensive at these prices, and probably the fundamental value is at about $10. However, obviously, with everything that's going on, it's difficult to be short selling in this market. So AMC is another company where this continued, and there are five or six more companies. There are cryptos where this went on. And so it showed the power of the crowd pushing these prices up. And also, like for most businesses, Robinhood struggled because, and this is what they were talking about, because their custodians and their back-end processing providers required more deposit, and they had to raise billions of dollars in cash to continue operations. So it was a difficult time for everyone, which is interesting because if you would have asked a broker last year, they would have said what they want to see in the markets is more volatility and more price action, because that means more, transaction costs, more brokerage. But these brokers were not ready at this point. And we saw a similar situation last year with the oil price when it went below zero. Again, the brokers were not ready. So I think it's again a learning and being ready for the unexpected in the markets. So since we're talking about memes and meme stocks, this is one that was quite interesting. And if you follow the Facebook posts, and some of this you would have seen in crypto before, which is now moved over to the stock market, wherein people are encouraging other people to buy stocks, obviously, that they own. And then if things go bad, it's about, hey, buy the dip or, hold and all of those things. But it's all around price action. It's around, hey, this is worth, let's find a penny stock, which is worth 0.07, and it might go to 0.7, giving us a 10x return. So extremely crazy times. Something that, again, personally reminds me of 1999. So all of this that happened, who lost and who won, right? So short sellers, hedge funds, and Melvin Capital, they lost money. Several retail investors, right? And the thing with this is that with most things in life, people talk about when they win, but not many talk about when they lose money. And for every winner, there might be a lot of losers in the markets, but that's something that you don't see. And this is why, I mean, this is what you can see some examples. Now, obviously, who won? Some retail investors. Interestingly, the guy who started the whole GameStop, the guy is called Keith, I think. He was on the hearing right now with the US houses. And what he said is he's still holding on to the stock. And I guess it was important for him to do that from a legal perspective, because if he did sell his stock, it would be called, a pump and dump. But right now, regulators can't go after him because he's actually not sold anything. At least that's what he claims. It was an amazing time for company insiders, Elon Musk's brother selling Tesla, or, management and employees holding onto the stocks for a long time can now exit. Same with private equity funds, VCs, all of that. With Reddit and other companies, this was an opportunity to prove their worth. So Reddit raised $250 million. So again, amazing. And brokers, I mean, I think, I don't know, I think how many million accounts have been opened in the stock market last year and this year has been phenomenal. So it's a great time for these guys. Now, what my personal view, the impact on the markets is the overvaluation will continue, because now people are not going to go short, and which means that, the only thing you can do in the markets right now is buy. Regulation. And I think what was really interesting for me on the call is on the hearing right now is that Robinhood was being grilled about the fact that they allow front running. So they get tens of millions of dollars each year from sending the order flow to Citadel, which is a hedge fund. And this was being questioned. And I hope that this thing can be resolved, because that's where the hedge funds have real advantage over retail investors. And the Robinhood CEO justified saying this is the only way they can offer commission-free trading. So then that makes us think about, is commission-free trading the right thing, the right way to go about in this market? Regulation and risk management, brokers will need to think about that. People will think about leverage. All the market participants will have to think through this. So I've been speaking a lot. So any thoughts from anyone, or any questions or anything? Anyone who wants to speak can just unmute and speak. You should be able to do that. Okay, I guess everyone's fine with this, or maybe it's too late in the evening. Okay. One of the things that annoyed me personally through all of this is how the big boys came in and started using Twitter to, promote companies, so Gamestop. And every time a mention would happen, you would see retail investors. And all what I'm saying is from me tracking what's going on in Facebook groups and Twitter chatters and everywhere else, because that's important for my company, City Falcon, to understand what people are doing. And people are just buying as soon as these tweets come out. Also, we saw, for example, Mark Cuban talking about, Dogecoin, whatever that is. Elon Musk also talking about buying it, for someone. And the things like these is these guys probably speculate with, 0.1% of their wealth. But some of this, all of this is legal, but I think it's a little bit irresponsible, because what it means is a lot of young people, and this was also on the hearing, that what they found was a lot of the new brokerage accounts are now being opened by much younger people than in the past. So they are, buying, they are taking loans, and that's not a great thing to do at this point. Any thoughts on this, on speculation, or do people disagree with me? Do you think it's fine? Yeah, Rob, go on.
Rose, on the subject of young people, the young people have the benefit of the. Let me put it differently. Having been around for 30 years financially, I am familiar with interest rates, inflation, and sticking money in the bank, watching funds grow in many different ways. But the only way you can make any money these days, if you're young, is by investing it. That's the only thing they can see and understand. They go down to the local bank, it's basically 0% interest. So this is it. This is their world, and it's the world of social media. This rubbish that's on Twitter, this noise that everybody's reacting to, it's no surprise that the young are just soaking it up and acting on it, that it's the only way they see to make money, and it's in their domain. It's all social media. It's their life.
Yes, agreed. And I think it's the key thing here is that people use the word invest, but what they're actually doing is speculating. And I think a lot of people, I've done mistakes. I started investing in the market when I was 19, and I lost, I've mentioned this before, I lost, I think 5% of my dad's pension fund in the first couple of weeks, which was quite stressful. And a learning. So I hope that a lot of these people will learn. But I think the sad part with all of this is that you can hear of suicides, you can hear about, like people losing a lot of money, being stuck with debts and all of that, which is at an early age would not be great. So here are some examples. Sorry, this is a long text, but I just wanted to give credit to Wall Street Journal. There's this one guy who took out a loan of $20,000 at a very high interest rate and then lost 80% of it in GameStop. Or there's another guy who, got loan at 11% and then, bought shares GameStop at $234, which is $44 now. So you will see a lot of these cases, but this is not what, everyone's following. Everyone's following, people are making a lot of money. I should be making money. So that's the FOMO, the fear of missing out. So, right. So that was kind of the, what is going on and all of that, which is, I think a lot of you are aware, and which is why I went quite quickly. So now is more interesting, especially for people who are, let's say, relatively new to investing. To start with, as we talk about buying, you buy low and you sell high. The short selling is the opposite. Sell high and buy low. Anyone has done short selling within this group?
Yes, crypto all the time.
Short selling crypto. Wow, that's gutsy.
You do it over maybe 1 or 2 hours.
Oh.
Yeah, just through yeah, just CFD.
Yeah, okay, good, Sam. Oh, you've done CFDs.
Small amount, yeah, very small.
Good. And sorry, Rob, I interrupted. By mistake, I pressed the mute button. I apologize.
That's okay. Yeah, provided you do it over a short time frame, most cryptos will sort of oscillate during the day up and down over a fairly narrow band of 2 to 3%. So if you watch how it oscillates through the day, you can sell high, buy low, sell high, buy low, and just keep going.
Wow, interesting strategy. You could probably, knowing you probably can write an algo to do this as well, automated.
Tried, to be honest, it's not as easy as it sounds.
Yeah, agreed. Cool. Okay, so let's move into it. For people who haven't done this, selling. Sorry, Rob, I'm gonna put it. Yeah, it's quite easy, right? In the sense that this is a CFD platform, and instead of clicking the buy button, you press the sell button, right? And we talk about short selling is about kind of, you can't sell something that you don't have, so you have to borrow and sell. But all of these complexities are handled by your broker or the financial system. And it's not perfect, which is why you saw, Gamestop being shorted, 130% of its market float, which means that people are shorting more than the actual number of shares in the market. But it's pretty straightforward. I think what you need to figure out is with your broker, if they allow short selling or not. Not every broker allows that. Or if they allow, there might be some risk management in place and all of that. So let's jump into the basics of value investing, right? So for most people, for most of us, we know that we compute the intrinsic value of a stock or anything that we want to invest in, and then we look at the market price. So when it's underpriced, this is the time you buy. Now, when it's overpriced, this is the time you sell, right? And you short sell. Is there any downside of doing it? Again, as a value investor, if you see Tesla at $800 today, and the Tesla is not worth that much, what would you short sell?
Only if you believe it's going to go back up again.
Oh, sorry, but you short sell as in, so you think the price should go down, right?
Yes, but I wouldn't short sell it unless I believed it would go back up to where it was again.
Okay. Anyone else?
Put that into GameStop context. I wouldn't touch that stock because I'm not convinced it will go back up again.
Yeah. We'll talk about GameStop. It's interesting on what can be done there. Okay. But this is the basic principle, and we will talk about the issues, like what are the risks that you're taking with short selling later in the presentation. Yeah. So the key thing here is that when you buy a stock, right? Let's say I buy something at $10. My maximum profit is unlimited. It could go to 1,000, 20,000, whatever that number is. And my maximum loss is $10. Now, the only exception to this was what happened to oil price last time, right? But it's a derivative contract. It's slightly different. But while you sell, let's say the price is $10, your maximum profit is $10 if the price goes to zero, but your loss is unlimited, right? The price could go to 1,000, which means now you have to pay $900 back to your broker on your original investment of $10. Oh, sorry, 990. Is that clear? Any questions from people on this? Okay. And how would you protect yourself when you're selling? Like, how do you protect yourself from this risk of, you having to owe $990 when you've done an investment of $10?
Stop loss.
Yeah, exactly. So you use stop losses, right? So you could say, I would put a stop loss if it goes about 20, and that would solve your problem.
And possibly 4 options, I guess.
Yeah. I mean, so we'll talk about futures and options, which is my next slide, as you see.
Right.
Yeah. So, I mean, for you to take a short sell or a position on the market in a security where you think the price will go down is, go through your traditional broker, CFDs or spread betting, and then futures and options. Now, does anyone know about CFD spread bettings? Now, how does that work? In the sense that when you sell something, okay, not all transactions go through your exchange. So what a CFD broker would do is, let's say someone wants to buy Apple and I want to sell Apple, they will square off our transaction. And this is why it's quite a profitable business. And what they will do is they will only take the net position, the net exposure between buy and sell of their users in the markets. So it's a great business. And then you have futures and options, which we'll talk about. And of course, don't forget your stop losses if you do that, because, as you know, the markets can go crazy anytime. So one of the most used concepts is called short interest. And just to understand that, it's just a number of shares that have been sold short, but they're still open positions. It's like imagine like a balance sheet item. These are the number of stocks which are, on the short side. And this is where, they said Gamestop was 130% short interest. It's been 130% of its normal float in the market is being shorted. The other thing you can look at is, so shorting is in the spot market, but other thing is also put call ratio. So we'll talk about what is put and call, but just for simplicity, a put is when you think the price will go down, and a call is when you think the price will go up. So you're buying these options. And as you see, the average should be about 1, but it's typically not, depending on the market's view on the stock. So if something is heavily, if the put call ratio is quite high, it could be something that you could use for the short squeeze that happened. So it means a lot of people are negative on the stock. Now, one thing to be careful is you should also understand why is the short interest so high, or why is the put call ratio so high? It may be because most market participants think the company is going to go bankrupt. And at this point, you might want to think, okay, then should I be buying in this market? Any questions until now on short interest and put call ratio? Okay. So now, I mean, if you wanted to do a short squeeze, just like we did at Gamestop, you need to find data, right? And so I found this one example where it shows a short interest screener, and it says AMC, has a float shorted of 67%. And this year it has done 161%. Okay. You will see some stock here at 446%, for example. So you see all of this. So if you look at this data, can anyone find an issue with this kind of data? Would you just jump in and now go long on AMC by looking at this?
I think not, because it might already be being overbought.
And how do you see that? Where do you see that?
With the relative strength index.
Okay. Okay.
I don't think it would be a great time to purchase.
Yes. Yes. The answer is right. Anyone else before I show what is the issue with this data? Okay. So see this date. It's 21st of Jan. What are we today? 18th, 19th, or 18th of Feb. Okay. So the problem with this kind of data is very difficult to find real-time data on short interest. And if you do find it, you're going to have to pay a lot of money for this. So the exchanges where you get this data from, they typically update it every 15 days. Has anyone seen any real-time or, let's say close to real-time data on short interest?
I don't know if in this show much less time in terms of?
Yeah, my guess also, I haven't checked Finviz recently, but my guess is also it will be probably the same data, because I think it comes from the same places. And to show you also on the exchange, so for example, NASDAQ, you will see that again, it's 29th of Jan, which was the last settlement date. You have data from that. And then it was 15th of Jan. So you see there are 15 days, delay, or every 15 days is reported. So it's very difficult to come up with a trend and figure out whether it actually exists. So, I mean, what Andre said is correct, is that the stock might be already overbought and the short interest already might have come down since its last reporting date. So let's talk a little bit about short squeeze. And I give credit to these guys, Centerpoint Securities, because this graph looks exactly like GameStop, right? And I don't know if they built it before or after, but I mean, what they're saying is there's a normal trading zone, right? And then once that leaves that normal trading zone, it's like a technical indicator and people start buying. And this is kind of the breakout event. And then you have a top that gets reached because now, companies have to buy back because, GameStop has already gone to 100. If they don't buy back now, it could go higher. And so they keep buying back and then pushes the prices up. So you saw that price go to $475. And then it came back to, whatever, 44, yeah. And so you see this trend a lot. Someone this morning commented that this also happened with Bitcoin, but I think that was not a short squeeze, but it was slightly different. But the charts are very similar. So how do we identify this breakout event, and can we do it for other stocks? Any thoughts? Okay. So, I mean, it's very difficult to time the market, as we know, right? It's how do we define what is the normal trading zone? It could differ from person to person. I mean, if you look at a particular stock, where do you think it is? Is it here? Is it here at the top? You don't know these things. And when such big moves happen, it's you have to manage the risk. So it's pretty risky. So going back to the thing about selling, just a reminder that remember that your loss is unlimited. So it's the same slide, just put again. So how do you identify these short squeeze candidates, right? So we talked about short interest and put call ratio, but also a lot of people look at low float stocks, wherein the jumps can be pretty significant. And then increased volume and volatility means that there will be more market participants, which is why something is happening, so you want to be playing in those markets. So a lot of trading softwares now would probably include these functionalities, wherein they will identify like a screener to identify which ones to look at. So any questions until now before we move on? Okay, this group is much quieter than the morning one. Okay. So let's jump on to futures and options. So the technical definition of futures is, it's a derivative contract. So it derives its price from the spot markets. And then it's a transaction between parties. And it's for a future date and price. And when I looked at this definition, when I started studying finance, back in university, I could never understand it. But once you've been in the market, you figure out how it works. So I'm going to give you a simple kind of analogy. Okay. I want to buy a car and I want to buy your car. Okay. The price is $10,000, but I offer you on 1st of Jan 2022 that I will buy it for $5,000. Okay. And we have to settle on this date. It's a contractual liability. Would you accept it? And if yes, why or why not? Like, what are the factors you would consider here?
You might break the car.
The owner might break the car. Okay. And will you be ready to take that risk?
I've never seen you drive, Russ, but no.
No, but again, I think, Rob, you missed the point here. So imagine you hold this car today for $10,000 and I will buy it from you on 1st Jan 2022. So the risk is that you might break the car and you might give me a broken car on 1st Jan 2022. And then I still have to pay you $5,000 for it. Yeah. But what is the, sorry, go on, Rob.
Sorry?
No, sorry, you were saying something. Sorry, I thought I interrupted you.
No, not at all. I was just agreeing with you.
Okay. Yeah, okay. So, I mean, and the key thing here is it's the time difference, right? So if you see, for example, today is 18th of Feb and it's 1st Jan 2022. So there's a big risk here in terms of what could happen over this period, right? And then ask yourself, like, why would I accept, to buy this at 5,000? Because maybe I expect that on 1st Jan, this car might be worth $20,000. And for me to get it at $5,000 is a great deal. I make 15,000 profit, right? For the seller, it might be saying, okay, the car is going to be depreciating in value and I'm going to use it for, I don't know, boiled food. And so 5,000 is not bad. And so this is why you enter this. And so this is spot, you buying or selling today, and this is futures. Any questions? Does this help people understand what futures means and what it does? I would accept it as yes. Okay. Now, with the same example, let's look at a stock, right? Apple is trading to let's say at 200, and on 1st Jan 2022, it's $220 in the futures. So why is there a difference again between the spot and the futures price?
Well, the 1st of Jan price is a prediction. Today is reality.
Yeah. 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 And why would you be ready to again pay $220 for Apple in 2022?
Oh, 2022, sorry.
Yeah.
Because it might go up a lot more than
that. Exactly.
Yeah.
And so it's your view on that. And there are a lot of things that can happen during this period. They might sell a lot in China. They might not sell. Corona happened. So you don't know. And that's the risk you're taking. So the time factor is really important. So if you were to take a longer duration, let's say now I change this to 2025, what would this price look like? Would it be higher or lower?
Higher.
And why would it be higher?
You'd assume it'd be increasing year on year.
And why would it be increasing? Sorry, I just probing a little bit.
Based on past performance and your belief in the future of the company.
Yes. Okay. And there's another factor here, which is probably not that relevant now, but wasn't earlier. It's also the interest rate, right? Because you will have to pay that $220 now, right? To get this contract for Apple. So you can't wait till Jan to pay. Now, there is an opportunity cost to this money. Now, you could have put this money in a bank deposit, which currently doesn't give you much interest, but in the past, it did give you that. Okay. So kind of the risk-free return is inbuilt into the futures pricing. So that is one factor. But in general, you don't know because it really depends on the view of the market. So for example, if you were to buy oil futures for, I don't know, 2050, okay, you might think that it might be replaced by renewable energy. And so the price actually might be lower. Yeah. And anything else you have to consider between like for this that might have an impact on the price? What about company announcements or activities like dividend? So if the company announces dividend, let's say $20, and the spot price goes to 180, right? But you're buying it at 220. Will you be compensated for that dividend? Yes, you will be in a futures. What is interesting is we'll talk about options later. In options, some of the corporate activities are not compensated for. So you have to kind of guess, okay, Apple might give a dividend based on historical and adjust the option pricing to that extent. What happens if there is a split or any other transaction? Typically, the futures market takes care of it. So it's generally fine. So here is an example. Again, I took it from CFD because it was much easier. So this I took before market open in the morning. So the prices may not be actually completely correct, but still gives us an idea. So if I was looking at BP in the spot market, it was 280.60. Now over here, the prices are, you see there are different prices here for depending on what futures contract you're buying. So does anyone see any trend over here with the prices?
Yeah, the buy price increase is greater than the decrease of the sell price.
So what is it? Yeah, you're right. Yes, but so what is happening here? The spreads are different depending on what period you look at.
Yeah.
Right? Which means that the broker is, either there is not enough liquidity for a particular forward contract, or the broker is doing risk management. Sen, you wanted to say something, sorry.
No, second, go on.
Yeah, okay. But you get the idea, right? How the pricing is different. And so for you to take an exposure in the futures market, you have to really decide which one you go after. So for me, sometimes I have to open an Excel sheet to figure out which is the best price I should get in at and what time horizon I'm looking at. To show you another graph, and I do not know the difference in the prices, but you see it shows the difference in the crude and the trend in the spot and the futures market. Okay, and with oil price, as we know, it's if I give you a barrel of oil today and we do a transaction, it's in the spot market. But typically, because it requires transport, oil is mainly in the futures market. So every end of the month or whatever that period is, I need to have my whatever super tankers ready to collect the oil. And that's why you have to do futures contract. Any thoughts on this, on oil? Okay. So hopefully now you understand the difference between spot and futures. So let's add one more complexity to it. So same example of buying your car. Now we can do it in two ways. Okay. Well, by the way, my thing was wrong. The payment needs to happen upfront. So security settled. So let's say I pay you $5,000 now and I take the delivery on 1st of Jan. Okay. That's security settled. So that's with oil, for example, or it could be cash settled. So instead of me taking the delivery of the car, if the price of the car is now 7,000, I just say, just give me 2,000 on top of my 5,000 and I don't take the car. So this is cash settled, which is what typically happens with stocks and indices and all that. Any questions on this? Okay, yeah, someone raised their hand. Yeah, go ahead, James.
Yeah. So is the cash settled aspect, is that written into the contract, or is that just something that you work out against it?
No, it is, James. It is in the contract. And it's very standardized, right? So when I go and buy with the CFD provider or my broker, like I don't get to choose any of these options. Does that make sense?
Yes, thanks.
Cool. Okay. So oil price, right? And then
quick question.
Sure.
So that previous slide. So that futures price of $5,000, is that price set by the market then? Is that?
Yes, exactly. It's if you go back to this, it's the price which is done here, which your broker is showing, which is again reflected by the buy and sell orders and the liquidity.
And the date on the left by BP PLC is the date when you'd effectively sell.
The contract expires. Yeah, the expiry date of the contract.
Okay. All right.
Instead of the date. So you're buying this futures contract which settles on, let's say this is 30th September 2021, but you can still sell before that. So you don't have to, or you can buy. So it's all traded, which is amazing.
Okay.
Cool. So the oil price, as we saw, went negative, right? And we won't spend a lot of time, but this was basically because people couldn't take delivery of oil. And so when you're trading with anything which is security settled, make sure you understand this and make sure you close your position before, the settlement date. So you can, buy oil and then, 2 days before you settle. In fact, a lot of brokers would ping you, would send you a couple of emails saying this is what is going to happen. And so you need to square off your positions. Some brokers even automatically square off because obviously they don't want to take the risk of this. So that was futures. Now let's look at options. The key thing here is the stock option is the investor has a right, but not an obligation. Okay. So, and we'll again take an example. And then again, you have puts, which is you believe that the stock will fall, or it can be calls where you think the stock will rise. Yeah, so this is pretty straightforward. Now let's take our own example. Now in our example, instead of me committing to buy on 1st of Jan, I say I want an option to buy on 1st of Jan at $5,000. Okay. Now, in this case, the buyer has the right, but not the obligation. Now, why would the seller agree to something like this? Any thoughts? It's risky for the seller, right? Like buyer can decide to buy. So buyer, let's say on 1st Jan, if he thinks the car's value is at $2,000, he's not going to buy it. And if he thinks it's $20,000, he's going to buy it. So what's in it for the seller?
Premium.
Yes. So the seller will ask for a premium. He will say, okay, I'll give you this option, but you have to pay me something upfront. Then let's say that's $500. So now if you don't take delivery on 1st of Jan, I keep the $500. So as a buyer, you would look at the price of the car and you say, hey, the price is $6,000. So then maybe I should take it. And then my net profit is 6,000 minus 5,000 minus the 500 I gave upfront as premium. So it reduces your profit, but it also limits your downside. So the loss on this transaction is only $500 instead of, you having to shell out the entire $5,000. Any questions? Okay. So let's look at, for example, and you can find this on NASDAQ, and most of it is live, so this is good. So if you want to look at Apple's option chain, okay, you will see a lot of these different strike prices. So let's say Apple is trading at $130, okay, which is here. And then you have different prices here that you can buy and sell. So these are calls, okay? So what it means is if you want to buy a $130 call, which expires on 5th of March, 2021, you have to pay $3.70. Okay. So on 5th of March, what should the price be for you to break even on this trade? Any idea? Okay. So I paid $370 as a premium, right? The strike price is $130. So the price has to be higher than $133.70 for you to make money. Okay, because this is the premium that you pay for the option. So let's break that down a little bit, right? So price again, $130, expiry 5th March. A strike price, you can decide any price you want to take from here. Okay. But typically when I'm buying a call, I want to buy something which is called an out of money call, which means that if I think the price is going to go up, I'll buy a slightly higher. So I took 135 is an example. And let's say the premium is 2. So my break-even point is 137. So as long as the price is more than 137 on 5th of March, I'm making money. Okay. So help me, please, and try and guess, even if you're wrong, it's fine. If Apple's price is 100 on 5th of March, what is your loss?
$37.
$2.
Okay. Okay. Other answers?
$2.
Sorry, how much?
2.
2. Okay. Anyone else? Yeah. So the answer is $2. And the reason is that when the price is 100, you're not going to exercise your option, right? So what you would do is you would say, okay, I gave $2. I'm going to let it be. That's my loss. Done. Now, what happens at $135? What is your loss?
$2 again.
Any other answers? Okay, so $2 is the right answer because again, it's at 135. So I would not exercise the option. So all I lose is my premium. What about 137?
$0.
No loss.
Yeah, it's the break-even point. It's 0, right? Okay. Now what happens if it goes to 500? How much money did you make?
A lot. I need a calculator.
What would you do? Let's say.
So it's 500 minus 135. Sorry, 500 minus 137. I think. Yeah.
Okay. Any other answers, Victoria? Go on. Okay. So that's correct. So you would do 500 minus 137. So this is 363, right? And so you see the power of the call option. So on an investment of $2, you could make $363, right? That's a phenomenal rate of investment. And on that same transaction, your maximum loss is $2. It's great, right? Why wouldn't everyone do options? Does anyone see any downsides in doing this?
Well, it might not go up, go down.
Yeah, but then you lose only $2, no?
Yes.
So you're still okay. Or are you not? Okay, the challenge here is as the volatility in the stock goes up, your counterparty will not give you for $2. I mean, Apple, they're giving you for $2 because they know Apple's price doesn't move so much. But if it was Gamestop, you wouldn't get it for $2. And so we'll look at that. But still, options is a way that, if you wanted to bet, I wouldn't play with any of these stocks, GameStop, AMC, with my hard-earned money. Capital preservation is, my number one priority. But if you wanted to speculate, you could use options to do this. Now, let's take another example. So now instead of looking at call options, we look at the put options. And again, it's on the same page, but it's on the right. Okay. So let's say 130 is the strike price. I have to pay a premium of 2.80. Okay. On this trade. So what is my break-even point? So remember here, I'm expecting the price to go down because I'm buying put options. Anyone?
So it's 130 minus 280. So
correct. So 127.20, right? So if it's below 127.20, you make money with this trade. So let's break that down a little bit. So again, 130, same things. Strike price 125, because as I said, I like it to be different and lower. Typically also select a strike price, which are round numbers, because that's where you'll see the most trades. And it's good for your, when you have low trades, then the price is not in line with what you expect. And let's say the premium is $1. And so it's $124. Okay. So let's start with when the price goes to 0. How much money did you make? Anyone?
124.
Yeah. Brett, what do you think? So you're saying something? Hey, I think there's a problem with the microphone. Yeah, so it's $124 here, right? Because you sold at 124 and now you're buying at 0. So that's all of your profit. What happens when it goes to 500? What is your loss?
$1.
Yes, it's $1. So do the people see this? So when you invest $1, and if the company would have gone bankrupt, you would make $124 on that trade. And if on the worst case it goes higher, you lose $1. Any questions until now? I know it's a bit complicated, but once you start playing with these numbers, it actually is quite straightforward. Okay, let's move on. It's not just that you are stuck until 5th of March with your trade. Once these are traded, so you can again exit. So I looked at Blackberry options, and you look at the period between last 2 weeks. The price of a Blackberry option was somewhere at 3.5, and now it's at 1.5. Okay, so you could have made money and you could have exited. So you don't have to wait till the end, which is again great. Right, so now that we've done this, let's see if we can come up with a strategy for Gamestop. And again, I'm not saying we should do anything, but I'm just saying if you wanted to speculate. Okay, now these are Gamestop call options. Can anyone see a trade here that they would do? So the current price is about $44. Okay. Would you think you would buy call options if you think the price is going to go up? And if you think, which one would you buy? Okay, let's start with this, right? Let's start with $45. So if you wanted to buy $45, you have to pay a premium of $18. So what is your break-even point? It's 63.35, so 45 plus 18. So as long as the price stays above $63 on 16th of July, you make money. Okay, and as you see, as you change this period, the premium will change. Now, $18 premium on 45 is pretty hefty, right? It's not $1 on 135 that we saw with Apple. So what would you do here to reduce your risk? Because imagine I want to buy 1,000 shares. I say, oh, it's only $18, but it's going to cost me $18,000. And I might lose that money. So what is it that you can do here to reduce your loss?
Maybe just for a lower premium?
Yes. And so which one would you go for? Where do you see a lower premium here?
Well, for instance, the 15.91.
Exactly. So you would look at this, and it's strange that this, ideally it should have been, this should have been the lowest because it's further down. So let's take the last one, right? So 50 strike price. Now you pay 16.60 instead of 18.35. But what happened to your break-even point here? What is your new break-even point? It's 66.60. So here is 66.60, here is 63.35. So as you pay a little bit lower premium, you're giving up something on your upside. But if you believed when all of this started that GameStop is worth $500 or it might go to $500, then you don't care with $3 up and down, right? And similarly, if you thought it would go to 500, you could have bought something at 100, a strike price of 100. And let's say over there, you have the premium might be 5. So your maximum loss is 5, but now your break-even point becomes 105. I know it's a bit late in the evening. I know a lot of numbers. All right, let's go ahead. So now let's look at the other side. So like if you believe that the stock is only worth $10, what are the strategies that you have? Can anyone see any trade here with all of this data? While I take a sip of water. Let's say, let's go back to 45, right? And we say, let's say we believe GameStop is worth $10. So now 45 minus the premium. So that's about 27.40. So 27.40 is your break-even point. And let's say it goes to $10. So 27.40 minus 10. So you make $17.40. So you put in 17.60 and you might get 100% return on that if GameStop goes to 10. And if it doesn't go, and if it goes up, then the maximum you lose is 17. Now, in this case, how would you lower your premium? Where would you go? You would go up, right? You would say, I would strike price of 42, where the premium is now 15. And the break-even point is, very similar, 27. So this is actually a better trade for me. So again, you can open an Excel sheet, but you see the volume is quite low. So maybe this price is difficult to get, while here the volume is high. And it also shows you the open interest, which is useful. It's how many people already hold positions in these contracts. And these numbers are not a lot, as you see. But again, I took this before the markets open, so maybe it changes where the market opens. So anyone feeling gutsy to do these trades? Or at least think about it?
Not GME options.
No, you don't like options.
No, not GME. It looks too volatile. And
yeah, okay. Yeah. Yes. Okay, not GME. Okay, fine. Maybe follow the Reddit post and see what is the next thing that goes up, and instead of buying, stock, buy options. No, too dangerous. But again, it keeps your downside low if you wanted to speculate. So going back to the basics and futures and options. So profit is unlimited. In case of futures, losses are unlimited, but options is limited to premium. With futures, you can have stop losses. That's how you control your losses. With leverage, our futures have, medium to high. Options, you can do low leverage, but it means that it almost trades like buying in the spot market. And the reason for this is that, with futures, you have 3-5 options. With options, you could have 200 options, like 200 option contracts to choose from. So you can decide how much leverage you want to keep in the contract. So looking at all of this, why would anyone trade futures? You should be just trading options, right? What is the case for futures here? Can anyone suggest? No? Okay. Let's look back at the numbers, right? So we looked at the price at 45, and I think the price will go to 40, and I want to trade this decline from 45 to 40. I cannot do it through options because I'll have to pay 17 as the premium. I mean, I could pay 17 as a premium and then hope when it falls, the price of the premium goes up and you make money. But it's the option market is not, the liquidity is lower. So it's tricky to do that. In this case, futures is better for me. So I could trade at 45. I could short in futures, put a stop loss at 50. And if it goes to 40, I make $5 out of this. Someone in the chat. Okay, that's fine. This is always gone. Okay. Let me see if I missed any slides. Yeah. So why would you not just go and short GME right now, right? If you think it's $10 worth. And the answer is something that I keep reminding myself. This is this quote that I've seen it happening time and time again. So for example, you would buy a stock which you really believe in, where you think the price is significantly lower than fundamental value. You'll hold it for 5-6 years and nothing happens. And so you sell it. I did that with Blackberry. Blackberry owned property in Canada, which was worth quite a bit. So, they were doing software for the car. So I bought it, I kept it, it never moved. And then I sold it because I was like, hey, and now it moves, but now it moves for the wrong reasons. So this is something to always remember. It's, markets can make you bankrupt. So what is the strategy like last time? Right now, I think people are doing investing, trading, speculating. Just, whatever you do, just believe in what you're doing. So a lot of people are speculating, but calling it investing, which is very risky, because with speculating, you would put a smaller amount of your portfolio, you would have stop losses, you would have exit strategies, similar with trading, while investing is something you want to hold for 10 years, for example. If you forget, and if people keeps, this is the common phrase you will hear, this time is different, right? And so you're looking back at history, every bubble this time is different. So I keep watching the movie. I love it. And I love the way the movie is presented. The screenplay is fantastic. But it just reminds us with the things that could go wrong. Very quickly, our platform, if you've not used cityfalcon.com, we have, we aggregate content. We're focused. This is why I conduct these. I learn a lot from you guys. So you can track your portfolio. You can see the sentiment. We're also launching an automated summary. So instead of reading news articles, you get a summary. Very, very easy to consume. So that's it really. And the quote from Warren Buffett, it's overused, but I think it's very relevant. So, be a little bit fearful right now when everyone is greedy. And then when the markets turn, you can be greedy. That's it, guys. And any questions, anything before we close? All right, great. Have a nice evening and good luck with your trading, investing, or speculating. Take care. Bye-bye.
Thank you. Bye.
Bye.
Thank you. Bye-bye.
Thank you.